I make that gone just 6 o'clock, so I am going to crack on. So a couple of you joining us this evening for our online tutorial for FAR, and this tutorial is all about the consolidated income statement and the consolidated statement of cash flows. Now, before I continue on, can I just get a confirmation on the chat panel that you're able to see my screen and that you can hear my voice? It's a bit weird because those of you that can't hear me obviously won't be able to respond, so I'll just give it a second. If you can just write on that panel that you're able to hear me. No responses there. A few responses. Can you just kindly respond on that, just so I have a rough indicator of those of you that are able to hear me? So thank you. Is that Elaine? Thank you, Elaine, for the response there. I think a few others are joining us this evening. Okay, well, I check that you are able to hear me, and this is being recorded. So for those of you that do have issues with sound, or in terms of not being able to see the screen properly, or the connection's not great, it is recorded. It will be uploaded on the community, so you'll be able to view that at another time. Now, I'll start by just introducing who I am. My name's Kritika Adatia, and I am one of the tutors here at Kaplan, teaching predominantly the accounting, reporting, audit and assurance stream. I do have Rajan Darbar on the chat panel this evening with us, so if you have any issues or concerns with any content that we're looking at today, definitely just post a question on the chat panel. If it's something that I'm able to address fairly quickly because I see it pop up on the screen, I'll make sure that I'm addressing it, but he is there to definitely help you out if you've got any issues as we work through today's questions. Now, really the purpose of the online tutorial tonight is to practice exam-style questions for our group income statement and group cash flow. Now, remember, in your exam, you're looking at a syllabus weighting of about 35% or up to 35% for groups, okay? Now, in the March exam just gone, the students did see 2 questions out of the 5 on groups. One of them is a definite guaranteed question on groups, so you're potentially going to see a consolidated SFP or a consolidated income statement with a consolidated statement of changes in equity. Often they tend to examine that with your disposals of a subsidiary, hence why we are showing in this tutorial an exam question that does accommodate that. Now, the group cash flow question is not a guaranteed question. It did get tested in March sitting just gone. That's not to say that you're not going to see it in June. It's never say never with the Institute. They do like to test things through again. So we are going to be practicing a group flow question as well. Now, group cash flows, if you're comfortable with single entities, to be honest, the mechanics of preparing your group cash flows is no different, okay? Just a few little extras that we'll touch on before we practice the question, and really the technique, the mechanism of it is in essence the same as single entities, okay? Hopefully you've been able to do is print off the FAR online tutorial 3 workbook, because that's what we're going to be working from today. Okay, starting off with the income statement. Before we go into a question, what I really would like to do is just have a very quick high-level recap of what we're thinking about when you have a disposal of a subsidiary. Okay, now realize that in the individual account, the individual final statement of the parent, when they dispose of a subsidiary, in the income statement, they will certainly reflect a gain or loss, but that's really just going to be a comparison of the sales proceeds against the investment number. Remember that from the parent's perspective, when they buy in another business, all think about doing is recognising that investment at cost, and they will not really be doing anything else with that number. Therefore, when it is disposed of, really it's a simple calculation where you compare your proceeds against the investment. From a group perspective, however, you've been consolidating this subsidiary, so you're essentially getting rid of all the net assets that you had previously consolidated, but as well as that, you're going to be getting rid of the goodwill relating to that subsidiary that you would have previously consolidated. So your calculation isn't as straightforward as a comparison of the proceeds against the investment. Okay, so from a group perspective, calculate a loss on discontinued operations. Now realise that a subsidiary will generally constitute a discontinued operation. It is going to be some sort of separate major component of the parent, and by getting rid of it, you need to have a separate disclosure in your income statement, and you refer to it as a gain or loss on discontinued operations. Now, the number is going to be made up of two things. It is going to be made up of profit subsidiary up to the disposal date. Okay. During the year. Okay. It's also going to comprise profit or loss of disposal itself. Okay. Now this is a separate formula. I'm going to highlight just underneath. We are going to visit this formula when we do the question, the exam style question together. Okay, but really your profit or loss on discontinued operation is a combination of two numbers. Okay, now thinking a bit further about the profit or loss on disposal, this calculation is a comparison of what you've received against what you're getting rid of from a group perspective. Okay, you're going to start off with the proceeds, deduct the value of the asset, subsidiary disposal, you're going to get rid of the goodwill of the subsidiary at disposal. Adding to that, you're going to be adding back the AI at disposal. Because you must realise that the proceeds that are being received reflect of the proceeds for the parent's shareholding. Okay, you're deducting the 100% of the carrying value of the net assets at disposal. Okay, and in essence, 100% isn't what you would have owned. So you need to think about adding back the NCI component at disposal as well, and that is going to give you some sort of gain or loss on disposal. Okay, think about this formula a bit further. We'll talk about the individual components as well with numbers. It will make a lot more sense once we introduce some numbers. Okay, then is crack on with the exact technique before we attempt our question. So back into our workbook. I have is exact technique. Now, you may have a technique that you developed as you practice questions. However, this is something that we encourage students to follow. You have to set up your pro formas. Okay. Obviously, before you do that, you need to read the core requirements. So once you've read the core requirement and you understand that you're preparing a consolidated income statement, you need to think about preparing your pro forma. Okay, presentation marks are often available in FAO. You can see up to about 1.5 marks for presentation. So you want to make sure that you're setting up your pro forma, draw your income statement with your respective lines, and you have your discontinued operation line as well, okay? In a disposals question, generally the requirement does state that so-and-so disposal of this subsidiary does constitute a discontinued operation. So you want to have that separate line that says profit or loss on discontinued operation. Okay, so you'll set up, remember that it's a group income statement, so you need to have the profit that's attributable to the parent and also to the NCI, nicely separated at the bottom. Okay, so with your group questions, the way that it's going to be tested, the examiner wants you to use some standard workings. So what standard workings? 1 to 3 for our income statement. We'll practice this with our question. Remember, your working 1 is your group structure. Your working 2 is your consolidation schedule. And your working 3 is your NCI profit, the profit that relates to your NCI. It's your NCI percentage multiplied by the subsidiary's profit after tax. Okay, there might be some adjustments that you need to think about that you'd have to plug in to your consolidation schedule, but generally when you have a disposal of a subsidiary, they don't tend to keep these adjustments too involved. They have the common perp that they test, things like impairments that you might need to filter in. Okay, or point 3 in our technique is to remember to introduce the parent and subsidiary revenue and cost items into our consolidation schedule. Remember to pro rata if there is a subsidiary that was acquired partway through the year. Okay, so sometimes what you do see is maybe during the year, parent has acquired a subsidiary and we're only interested in consolidating a subsidiary from the date of acquisition. Okay, so if a subsidiary is acquired, let's say 31st of March and our year end is 31st of December, well, you're only going to consolidate the 9 months of the year. Pro-rating is generally worth a separate mark. And in your exam, we do consider that a fairly easy mark. You want to make sure that you're reading the dates carefully to take out if you do need to pro-rata. In dealing with your adjustments, we do encourage students to prioritise. There are often certain adjustments that are quicker to deal with than others. So maybe you feel more comfortable dealing with an inventory perp rather than an NCA perp. It will just mean that when you prepare your workings, try and focus on those adjustments that you know are quicker to respond to. Okay. You want to make sure that you complete your working too, and you also calculate your NCI and deal with the disposal of a subsidiary correctly. Okay. You would need a separate working. Okay, and I'm going to show you just how you can prepare that separate working and how it all does nicely link in. Okay, and if you prepare your working in the way that we're encouraging you to with this question that we'll practice next, you're able to bank on getting loads of follow through marks even if your final answer isn't quite spot on. And remember to transfer your workings, complete your income statement, because if you don't do this bit, you're not really answering the question, because the question would have said, give us the income statement. Okay. Often, the income statement is tested together with the statement of changes in equity. And that's what you generally do tend to find, and we'll see that in the questions that we definitely practice over revision. Okay. So let's crack on with the question. Question on page Jennings PLC. Now let's read the requirement first, because the first thing we want to do in terms of our exam technique is read the core requirements. That way we know what we're dealing with. So I'm going to skip over a page or two to bring us to the core requirement. Okay. Now the core requirement here is to prepare the consolidated income statement of Jennings PLC for the year ended 31st of March 2010. Okay. What we've got is an assumption that the disposal of Ferrero Limited is a discontinued activity. Okay. This is in accordance with IFRS 5, non-assets held for sale and discontinued operations. Okay. We have a part B that says calculate the consolidated retained earnings brought forward at the 1st of April 2009. Okay, so we'll have a think about that as well. Once we've read the requirement, what we could do is draw out our pro forma. Okay, rather than draw out the pro forma now, what we're going to do is active read of the question. Okay, by actively reading the question, we're going to be annotating in the margins, picking up what each note is telling us to do, and particularly think about the areas of impact in terms of our standard working. Okay, so let's do that. We go to the question, and it reads, so this is the core requirement. Having been read, now reading the detail of that requirement, it tells us that at 1st of April 2009, PLC had investments in 3 companies. Okay, what we do know is that Ferrers Limited has been disposed of. What I might be inclined to do is just box around the subsidiary that I know has been disposed. What remind me to do is to deal with that separately as a profit or loss on discontinued operations. I will also remember not to include that in my working to. Okay, your working to is your consolidation schedule that should only include your continuing activity. So really just the subsidiaries that are going to be in your business for the year going forward. Okay, so we've got Ferrers Limited disposed of, then there's Brandon, and then there's Palmer. Okay. Extract for the draft individual financial statements of the 4 companies are shown below. So we know that Jennings is the parent, Ferrers was the subsidiary that had been disposed of. We don't know what Brandon and Palmer are, but as we read on, we'll be able to find out whether they're a subsidiary or whether they're an associate. Okay. Further down, they give us information about the extracts of the individual statement of changes in equity. Now, when I have a quick look at that, I'm thinking to myself, maybe that's relevant for the Kosocki part in this question. Does want us to count the retained earnings extracts in our Kosocki? Maybe we're thinking that information or relevant for that. Page into the detail of the note, what do we have? Well, note 1 is giving us information about the shareholding. It's brilliant because it's going to help us with working 1, which is our group structure. Okay. What it tells us is the shareholding that Jennings has acquired and the total shares, the ordinary shares in respective entities. What I can do is just have a quick calculation to remind me whether it's a subsidiary, whether it's an associate. So I know that Ferrers is definitely a subsidiary. They kind of tell me that in the requirement. It's one of their subsidiaries they've disposed of. Okay, I can work out the shareholding by taking the 6.4 against the 8 million. That would give me 80%, confirming that it was a subsidiary. We're now disposing of that shareholding. I can do a similar calculation. I can work out that Jennings has 4.2 million of shares, 6 million is the share in total. That gives me 70%, confirming that Brandon is also a subsidiary that I want to consolidate. However, if I count the shareholding there, it's the 1.6 million against the 4 million, plus a calculator, and I get 40%. Okay. Oh. So I'm based there on the side, but just keep that clear. Let's just bring it down. It reflects 40%. Okay. That tells me that is an associate. Okay. I do not want to consolidate my associate. Okay. We equity out for the associate. So if I go back into my statement, what I want to do is just annotate here that this is a subsidiary. Actually, Palmer's an associate. So maybe draw a line before financial of the associate I do not include them in my working two. Okay, so it's just to ensure that I don't start consolidating. The last thing you want to do is consolidate your associate when actually you equity account for the associate. Okay, so into the note, and it tells us that no company has any reserves other than retained earnings. Those are the assets and liabilities of all three companies at acquisition were the same as their carrying amounts. Okay, tell us that there's no fair value adjustments that we factored in. Jennings PLC is calculating the NCI goodwill using the proportion method. Okay, so it's telling us that they are using share of the net assets method. Okay, now then, let's think about the relevance of Note 2. Note 2 is giving us information about the shares in Ferrers Limited, which they acquired for 10 million. Why is that relevant? Well, we need to calculate the goodwill at disposal. Okay, and that's going to help us determine that number. Remember, your goodwill is calculation comparing what you've paid against what you're acquiring when you buy shareholdings in a subsidiary. Retained earnings of Ferrers was 550 at that date. Okay, and that's going to be relevant to help us with our goodwill calculation. It says on the 30th of September 2009, okay, and that's obviously our current year, Jennings sold all of its shares in Ferrers for 50 million. So that's going to be relevant to work out the profit or loss on disposal. Okay. Also, be very careful to read the date. It is 30th of September, part into our year. Our year end is March, so we're thinking about 6 months into the year that this transaction has actually happened. Okay. Read that Ferrers Limited's profits accrued evenly through the current year, and at 31st of March 2009, cumulative impairment losses of 500,000 in respect of goodwill had been processed or had been put through. Okay, so what that's telling us is that when we do our goodwill calculation, we reduce the goodwill by the impairment number. It might also have a knock-on effect when we think about the brought forward retained earnings. Okay, brought forward retained earnings calculation for Part B. Okay, trying to squash I write in there to fit it in the margin. Note 3 is telling us that Jennings acquired its shares in Brandon on the 1st of April. So that's at the start of the year. Okay, so no pro-rating to worry about there with our second subsidiary, and the retained earnings were 10.4 million. At 31st of March 2010, an impairment loss of 700,000 identified relating to Brandon. So it's going to impact our working to the consolidation schedule. Okay, we're going to need to process that impairment. We are using the NCI at the share of the net assets method, so it will be in P's column that you see this adjustment filtering through. Note 4 is telling us that Jennings PLC acquired its shares in PAT several years ago when the retained earnings was 600,000. Jennings PLC has calculated an impairment with regards to of 100,000. Okay, now that's going to impact essentially our profit share of associates. Now, when we equity account, you may remember from your e-learn and your self-managed learning that we think about identifying a profit share of our associates as the percentage multiplied by the associate's profit after tax. Now, if there's an impairment with regards to our associates, we're going to process that as a reduction to that calculation. Okay, so you'll see that in my numbers. Now, those continue over the page to tell in note 5, have during the year Brandon selling goods to Jennings. Oh, you got the subsidiary let's write that in a blue pen. So you've got the subsidiary selling to the parent. Okay. Now, whenever you have a transaction between parent and sub, you know that intragroup. When we consolidate, we reflect the single entity concept. And the single entity concept is this idea that P and S are treated as one unit. Therefore, any transactions happening between P and S need to be eliminated. So we definitely want to eliminate that transaction. On further to give us information about the markup and the cost. This is generally how information will be presented for your intragroup transactions in the income statement. The very sentence in that note mentions that half of the goods are part of inventory at year end, which means that the sale between the subsidiary and the parent has not, the inventory has not left PS. Okay, so if you imagine parent and subsidiary, the inventory is within that bubble. We would adjust for a PERP, okay, a vision for unrealized profit. Whenever you have a PERP, we're always doing two things. We are reducing the closing inventory in the consolidated SFP, and we want to reduce the profit in the books of the seller. Okay, so we definitely want to be reducing the profit. We're going to be doing that in looking to in the seller's column. And our seller here is our subsidiary. So things coming out from note 5, the intragroup itself, as well as the PERP adjustment, because the inventory remains between the P and S bubble. And whenever that happens, there will always be a PERP adjustment. Next tells us that investment income in Jennings PLC's individual income statement includes its profit from the sale of shares in Forest Limited. So what we want to do is remove this, because instead we're going to be calculating a profit or loss on disposal from a group perspective. Okay. It also includes the dividends received from Brandon Limited and Pound Limited. Again, we're thinking about some intra-group adjustments here. Us, having spent time actively reading the question, picking out the key bits of information. What I'm going to do on a separate page is work through this with you. Okay, so start by drawing out a pro forma. Okay, so I'm going to draw out my consolidated income statement for the ended 31st of March 2010. Okay. Remember getting a presentation mark, so having things like the title is definitely going to get you that presentation mark. Okay. I'm going to start off with my revenue. Remember that when you draw these consolidated pro formas, you often have to use the individual financial statements that they give you. So I'm going to use that as a basis. So we've got the revenue, we have the cost of sales, we have the gross profit. Okay. We'll have the operating expenses. We'll have the profit from operations. We've got the investment income. Profit the associates. We're going to have the profit tax. We're going to have our tax, and then we'll have a profit from continuing operations. Okay. We can know that there has been a disposal of our subsidiary during the year. And remember, in your exam, it will only be full subsidiary disposals. Part disposal you'll address later. Here, we need to have a line for profit or loss for discontinued operations. We want to have total profit for the year. We want to have the profit attributable to owners of the parent. Okay. And want to have the non-controlling interest. Take a minute or so to draw out this pro forma, but you want to make sure that you're drawing out this pro forma, writing it in full, because that's going to bag you that nice and easy presentation mark. Okay, so we've got our pro forma. What do we do next? Well, we're going to go through the standard working in order, and I take a new page for this. Start with my working one for the group structure. Okay. Group structure, my parent, and that's James. Okay. James has got a shareholding in Perez, which I'll refer to as my one. Okay. They're holding in Brandon, and refer to that as my sub 2. Okay. And at the same time, they've also got a holding in Palmer, and I refer to that as my associate. I've already worked out my shareholding, but I want to confirm the examiner again just how I derived this. So I'm going to just reproduce my shareholding calculation. Okay? And your group structure generally worth about a mark or so as well. So definitely worthwhile spending that minute getting this down. I would also suggest is maybe follow around your subsidiaries. Okay, so you know that your subsidiaries are the ones that you consolidate. Your associate is the one that you equity account. In addition to that, I'm going to put in some extra information to remind me that this subsidiary, or subsidiary 1, was disposed on the 30th of September 2009. Okay, so I want to remember to include it my working too. Now you don't need to mention that to the examiner. I've only done that because I know that it's a tutorial exercise, and when you're going back and looking at your working, you can see that this was a subsidiary we disposed of. We want to include it in working too, which is our continuing activities. This was acquired 1st of April 2009. So at the start of the year, we don't need to worry about any pro-ratering there. Okay, Paris was acquired several years ago, so not an issue. Okay. What I also want to do is note the NCI percentage. So NCI for subsidiary 1 is 20%, NCI for subsidiary 2 our 30%. And obviously with the associate, your equity accounting, so there is no NCI with our associate. I can produce my group structure with as much detail as possible. I move on to my working too. Okay, and let's be consistent. Let's write that out. Working to consolidation schedule. Okay. And I remind myself that working to consolidation schedule should be for my continuing operations. Okay. Those subsidiaries that do remain at the year end. So I have my subsidiary 2. Notice that I'm going to be abbreviating here for subsidiary 2 because already my group structure, I showed the examiner the S2, I'm referring to Brandon. Okay? I'll have my adjustments column and my total. And then just chart all the revenue and expenditure lines, leaving myself enough room in case I need to slot in extra adjustments. Well, we've read the question, so we have a general feel for the types of adjustment the examiner is testing. Then your exam, once you've done a read of the question, you may not have registered certain things, so I would advise to potentially take up an entire A4 page to work through your consolidation schedule and just leave yourself enough room so that if you need to slot in some extra lines, you have room to do so. Okay, so I've got my revenue and my cost of sales. Read the question, so I do know that there is a perp adjustment, and that perp adjustment was mentioned to me in note 5. Okay, so I'm just going to slot in that line there because I have read the question. I then have operating expenses. Okay. To abbreviate in my working, so as you can see, I'm abbreviating that, just as long as you don't abbreviate in your core pro forma. Okay, we read in note 3 about an impairment. So I'm just going to slot in my impairment line there. A general rule of thumb, if the examiner doesn't tell you where to plug in the impairment, link it against your operating expenses. Okay, what we have is investment income. Okay, investment income, a couple of adjustments required here. Firstly, what you'd have is a dividend adjustment. I read about all of this in the last note. So we've got the dividend adjustment, dividend received from our subsidiary. In addition to that, we also had dividend adjustment received by the associate. Again, if we refer back to the very last note, it does say that Penning received dividends from Brandon and Palmer. So we definitely want to adjust those dividends. And it also mentioned to us in note 6 that the investment income of Jennings includes profit on sale of shares in Infrared. So there's going to be an adjustment for the on disposal, which actually from a group perspective is a different number. Okay, I'm going to think about those numbers when I get to it. And I've got my tax charge. Okay. I've listed out all my respective income and expenditure lines and the adjustments that I thought about having read actively the question. Let's plug in our numbers, okay? Easy for just copying across parent and subsidiaries numbers from the question. Okay, so all I'm doing now, and you can reference back to financials for the parent, Jennings, and for Brandon, I am just copying across the numbers. Okay, I'm going to keep it simple by just copying across the revenue and cost numbers, and then I'll think about the adjustments. Okay, cost of sales. I've got my operating expenses, 12,700, likewise the 13,200 for our subsidiary. Income, 7,300 and the 1,000. Okay. And my tax charge, 4,000 and 1,700. So what you could do is just reference these back to your income statement. You can see that all I've done is put across the numbers for P&S. If you want to do that, that's some nice easy half marks in the bag. Okay. Once I've done that, what I then want to do in my adjustments, I'm going to prioritize here. Tell myself, well, impairment, they told me the impairment in note 3. Okay. In note 3, they explicitly told me that an impairment of 700 was recognised with regards to Brandon. So that's an impairment that I'm just going to plug in extra cost on parents column. Okay. Remember, the other side of that entry would be the consolidated SFP as a reduction to your goodwill. What else can I deal with? Well, they do tell me about dividends that the parent has received from Brandon and from Palmer. Okay? So what I can do is look at the ordinary dividends that are paid in the extracts of the statement of changes and equity given to me in the question. So if we look back on the first page, what they tell me in the extract, so let's just bring that up so you can see exactly what I mean. Okay, we bring the question, extract, they give me the dividends that have been paid by those respective entities. What I can do is work out the amount that the parent would have received. Okay, now parent's holding in Britain is 70%. And holding in the associate is 40%. Okay. So if I think about taking 70% of my 2,000, it's going to be the 1,400. Okay. And if I take the 40% of the 1,000, that's going to be 400. Okay. Now, what I want to do is, in my consolidation schedule, factor these numbers as a reduction to the investment income. Because from a group perspective, I don't want to be including the dividend that my subsidiary has given me, because that's intragroup. It's all about single entity concept. You don't want to reflect anything happening between P&S. At the same time, your associate is also giving you some money, and you don't want to reflect that because we equity account for our associates. Instead of showing the dividends they give us, we show the profit share of that associate. So eliminating these transactions, I'm going to go back in my pro forma and plug in those numbers. Okay, so I've got the adjustment for S, 1,400 as a reduction, and I've also got the adjustment for the dividends from my associates. And just so you don't get confused, I'm going to rework the calculations here. It's 2,000 multiplied by the 70%. It is 1,000 multiplied by the 40%. In addition to that, they also tell me in note 6 has accounted for the profit of the disposal in their subsidiary as part of their investment income. Now, from an individual perspective, we said up front that all the parent would be doing is comparing the proceeds that they've received, 15 million, and that was stated to us in one of the notes. So it did tell us in note 2, 50 million is what they received, and they had paid 10 million for the shares in Thorez when they originally bought it. So from a perspective, they recognized 5,000 as a gain. That's not quite correct from a group perspective. We want to strip out the effect of that because we're going to replace it with another calculation. Okay. Dealt with my adjustments of investment income. What that leaves me with then is adjustment for my tax. And all I have to do is reference a separate working. So reference a working 2.1. Okay. That's properly. So a working 2.1. Okay. And just underneath, I'm going to work through. I'll leave a bit of space to total things up. I reference a working 2.1 for my PERP adjustment. Okay. I'm going to remind myself that it is subsidiary that sells to the parent, and it is at a markup of 3%. Okay, they mention that all to me in note 5. Whenever I have a PERP, I always want to deal with it using my cost structures. So I'll take my selling price, my cost and profit, apply a markup on the cost, give me a selling price at 120%, the cost at 100%, and profit at 20%. Okay. Thinking about the numbers that they do give me in Note 5, so if we go back to Note 5, what does it read? Well, it says that the goods had cost Brandon 30 million. Okay, so cost is the 3 million, and I'm going to round in thousands there. So in order for this cost structure to hold true, the selling price must be 3.6 million. Okay, and that gives me a profit component of 600. Now, really, they tell me that only half of the inventory remains. So what I must remember to do is barter for the inventory that remains at year end, and that's going to be the 300. Okay, I must remember to eliminate entire intragroup transaction. Okay, and the revenue of 3.6 million that the subsidiary has recognised, and the cost of 3.6 million that the parent would have recognised. I want to separately adjust for the 300,000. I put the number in, back to my pro forma. Okay. I am taking the reduction revenue, okay, my debit entry, and I am crediting my cost. Okay, and again, I can be very clear, reference that back to my working 2.1. Okay, at the same time, I want to increase the cost of my subsidiary by 300 to reflect that PERP. Remember, with PERP adjustment, you're always doing two things. You want to reduce the inventory in the consolidated SFP, and you want to reduce the profit in the books of the seller. Okay. Now, if you want to reduce the profit, you need to increase the cost. Okay. Hence, this increase in the cost was 300,000. Okay. Having dealt with all the adjustments, I'm not in a position where I can just total up my consolidation schedule. So I do precisely that. So if I total up my revenue, the 106,500. I total up my cost of sales. Okay, be very careful with your positives and negatives here. We're taking all these three, the negatives, and we want to think about a reduction to our cost of 3.6. So that's going to give us 62150. Okay. We have operating expenses. And if I total up my operating expenses, that gives me 600. Okay. I then got my investment income. Now my investment income total up 1,500. Okay. And then I got my tax charge. And tax charge there 5,700. Okay. At this point, what I also want to do is total up my subsidiaries numbers. Okay. To need my subsidiaries numbers to calculate my NCI. Okay. For 655. If I wanted to, I could also at this point plug in all the respective income statement numbers into my pro forma. I'm going to do that now. We'll deal with it all together once we've done all the calculations. Okay. Let's move on to think about the actual calculation for NCI, profit. And one thing that you must remember is that this will be a combination of your subsidiary 2, and that's going to be the 30% NCI in Brandon multiplied by the 6,550 that we've calculated in working 2. So I'm going to reference that back. Okay, you multiply through, and that gives you 1965. In addition to that, what you must remember is that the rest, subsidiary 1, although you disposed of it, the prior year you did have the jazz in that entity, and you are going to be showing a profit or loss on discontinued operations for this entity. So you need to think about the profit that belongs to the NCI for the part of the year that you are including its numbers. Okay, so that's going to be the 20% multiplied the profit for the full year in that subsidiary. Okay, and I'm picking up this 800 from the individual account or and I pro-rata that for 6 months of the year, because I only had this subsidiary for 6 months of the year. That gives me 780. And I total that up, 245 is what I end up with for my NCI. Okay. Continue on to factor in 18.4. Because it's an associate, I have to derive the profit share of the associate. And the way that I take that is P percentage of the associate profit after tax. Okay. For us, that's going to be the 40% multiplied by the 6,400. Okay. And you end up with 2,560. In addition to that, in note 4, we did read about an impairment. Okay, in the impairment charge, which is about in note 4. Okay, so in your exam, you don't really need to reference notes, but seeing as this is just a tutorial exercise, I'm showing you the completeness where the numbers are coming from. Okay, and that's going to give us the 2,460. Okay. And that brings me on to a working 5. And I need to create this working to determine the profit or loss discontinued. Okay. And what you want to do is have two numbers in this calculation. You want to have profit of subsidiary 1, disposal date. Okay. You also want to have the actual profit or loss of disposal. Okay. The profit of subsidiary 1 up until disposal date, we work out because the entire year the profit made by the subsidiary by Ferrers was 7,800. We want to pro-rata that for 6 months of the year. Okay. And if you pro-rata that, you're going to get 3,900. Okay. What you want to do is calculate a profit or loss on disposal, and you're going to need to do a separate working for this. So I'm going to sub-reference a working 6. Okay. I'm going to give a bit of space and start my working 6. My working 6 for the profit or loss disposal. Now this calculation is a comparison of what I've received against what I'm selling off. And I've got my proceeds. Do tell me in note 2 is 15 million, and I'm rounding in thousands here, so I'm keeping that as the 15 million there. I want to deduct the carrying value of net assets at disposal. Again, I'm abbreviating here because obviously we're up against time in the exam. The examiner doesn't mind us abbreviating in our workings as long as he can follow them through. To work out the carrying value of my net assets at disposal, so I will reference another working. Okay. In addition to that, I need to deduct the carrying value of the goodwill of that subsidiary at disposal. Okay. Now, goodwill is normally calculated from an FP perspective using a working 3. Okay. And I'm just going to recreate that working in a working 8. Okay. So I'm going to add back to NCI at disposal. Okay. So this formula is looking slightly incomplete. I need to plug in all the relevant numbers. I've just run out of space there at the bottom, so I'm going to take a new piece of paper and filter in all the respective numbers. Okay, so just change that 7, which will be the cash value net assets at disposal. Okay, now assets is the same as equity. Okay, and so you remember that from accounting. So this will be share capital balance. Okay, they tell me that in note 1. Okay, take my retained earnings, brought forward, which I can pick up from the extract of the SOCI, which they give me. Okay, and then want to realise that if I want my net assets up to the disposal date, I need to include in my retained earnings the profit of subsidiary 1 up to disposal date. Okay. Now, any dividends paid by the subsidiary prior to disposal, you would need to adjust that here. But if we look at the extracts for our SOCI, Perez actually didn't pay any dividends, so that's not particularly relevant here. So I plug in my share capital, the 8 million. I'm going to plug in my retained earnings brought forward, so I can look at the individual extracts of my subsidiary. Perez, it was 2.7. Up until disposal is just the 7,800 multiplied by 6/12. Okay, and that's going to be 900. Okay, I took that all up, and 14,600 is the key value. Okay, I'm going to calculate just underneath at disposal. Okay. My goodwill at disposal, I'm just going to say it's my standard 3 for the consolidated SFP perspective. Now, I remember that this, your consideration million, which give us in the first note against the NCI. So add the NCI at acquisition, okay, and we're going to deduct 2% of the net assets at acquisition. Okay. Now NCI at acquisition, they explicitly told us this number, but we can work it out because the NCI acquisition is essentially the NCI percentage multiplied by the net assets at acquisition. So we can take the NCI percentage, 20%, multiply that by the share capital, 8 million, plus the retained earnings, the 50 that they give us in note 2. Okay, so I'm deriving all that information from note 1 and 2, the NCI percentage from note 1, and obviously the respective share capital and the retained earnings from note 2. Okay, so that's going to give me, by plugging those numbers in my calculator, 10. 100% of net assets is just going to be the 8 million. So let's deduct the 8 million plus the 550. So that's just the share capital and retained earnings. Well, net assets are the same as your equity balances. Okay, so you've got 8550. Also, what we must bear in mind is that in note 2 there was an impairment. Okay, I'm going to plug in my impairment to date. He did tell me in note 2 was the impairment relating to Perez of 500. That gives me the 2660. So at this stage, I've completed all of my workings that are relevant to deal with my disposal, so I can plug in my numbers into my profit or loss disposal calculation. So I've got the 14600 cash value of the net assets at disposal. I've got goodwill at disposal, the 2660. Now, CI at disposal, all this is, and because the share of the net assets method, I'm taking my SCI percentage and multiplying that by net assets at disposal, the 14600. You can just think of this as your standard working for SP calculation for the disposal date, okay? Normally you're working for in the SFP is your NCI working. We're trying to work out the NCI position at disposal date. So if you plug that in, 220 is what you get, and 660 is the profit or loss on disposal, okay? Plug those numbers into my core discontinued operations calculation. So I can plug in the 660, and that's going to give me the 4560. Okay. I've been fairly quiet on the chat panel. Hopefully you're following through with all these workings. If you have any questions, definitely bring those up on the chat panel, and I'll try and deal with them as best I can. Okay, so at this point we've dealt with all the workings. We're going to go into our pro forma and just filter those numbers through. Okay, so into our core pro forma, let's deal with the first bit of this requirement, the income statement. Okay, so I'm going to copy across now, referencing as I go along. Okay, I'm going to copy across my cost of sales, the 62150. Give me gross profit of 4450. Expenses reference back to working to, and that was the 2600. Your profit from operations of 17750. Investment income reference back 1,500. Profit of the associate working for 2460. To get profit before tax of 21710. Number 5700. For continuing operations at 16010. And a reference back to working 5 for continued operations to 4560. Okay, giving a total profit of 20570. I then want to remember to plug in the NCI's profit share. We're back to working 3, the 745. Okay, and I will always take the profit attributable to the pension as a balancing entry, and that is the 17825. And you don't really need to worry about proving it. In essence, that number is just a summation of the parent's profit and the parent's percentage of the subsidiary's profit after tax. Okay, often with half marks, sometimes no marks, so you don't want to waste time. Given that, you just want to give it as a balanced number to prove to the examiner that you do realise that the totals need to be the same. Okay, the 20570 both at the top and at the bottom. Okay. Having dealt with part A, what we'll now do is move on to part B, and part B in this question is to think about preparing the retained earnings. So if we read the requirement, the retained earnings earnings brought forward at 1st of April. I'm just going to do that underneath. Okay, so you do in part B relate the retained earnings brought forward on the 1st of April 2009 from a group perspective. Okay, so it's the group retained earnings that you're interested in calculating. Okay. If we think about the brought forward perspective, well, what you are going to have is the group plus subsidiary 1 for rent. You wouldn't have subsidiary 2, Brandon, because that was acquired at the beginning of the year. Okay, so you must realise that Brandon is not going to be part of your retained earnings brought forward because it wasn't in place. We didn't have the shares in that subsidiary at the start of the year. You're also going to have the associate. So we did have Jennings, Faraz and Palmer. Okay. Now, if we think about our retained earnings, it's normal, standard that we reduce for the consolidated SFP. What we have is 100% retained earnings brought forward. We're going to take that number SOCI to give us in this question the individual SOCIs, and that is the 23,800. What we then want is, for 1, percentage of G1 back movement. Okay, remember that we consolidate retained earnings. We are interested in adding a parent percentage of the subsidiaries post-DAC movement. Okay, so all we're realising is that at the start of the year, the retained earnings number for the group perspective would be the same as last year's closing number. Okay, so in last year's closing, you're going to have the post-DAC movement relating to Faraz up until the brought forward date. So that in essence is going to be percent multiplied by, and we need to work out the post-DAC movement. Now normally when you have a post-DAC movement, you typically refer to a working 2 in the SFP from an SFP perspective, but all we're going to do is we're going to take the post-DAC movement as the movement in our reserves. And remember, retained earnings is where you're going to see that movement. What you know is that at the start of the year, look at SOCI, the retained earnings brought forward were 2,700. Okay. When we acquired this entity, the retained earnings position that they do tell us in, I think it's in note 2. Yep, it's in note 2. Retained earnings at acquisition, it was 550. So the post-DAC is essentially the difference between the two. And if we multiply that by the parent share, you get 1720. In addition to that, you want to include the associate. You want to include the percentage of the associate's post-DAC movement as well. Okay. This will be a calculation where you take the 40%, the parent's holding in that associate, multiplied by, and look at the retained earnings position of Palmer forward. Okay. We can compare that to the position at acquisition, this 100, which they do tell us in note 4. Okay, so we know the retained earnings at acquisition. That gives us the post-DAC movement. Remember, when you equity account year on year, you are including the parent's percentage of the associate's post-DAC movement. Okay, so the dual impact is that you're increasing the investment in the associate, but simultaneously increasing your retained earnings. So that's going to be the 1580. Okay, a little quirk to remember is that the impairment that they mentioned okay, for subsidiary 1 has taken place in prior years. Okay, so we would need to realise that in the brought forward retained earnings, that number is a reduction. Okay, so totaling that all up, 100 is your retained earnings brought forward. Okay, right. So does bring us to an end for our first question of the online tutorial. A very lengthy one, okay? And I have worked through that at a bit of speed, but do remember that you've got this as a recording, so you're obviously able to watch it again, pause it, stop it at a relevant pace to suit yourselves when you see it uploaded on the communities. Okay, brilliant. I think quite a nice place to take a little breather, because before we come on to cash flows, want to have a little bit of a break. So I make that just gone at 10 past. So if we could take 15 minutes and just be back at around 25 past, what we can then do is continue on with cash flows. Okay, I'll stick around to see if you've got any questions in the chat panel to address, but a breather for 15 minutes there. We'll be back at 7:25. Okay. 11:25, so I am going to start on with the next session. Again, a quick sound check. So if you can hear me, if you could kindly just type on the chat panel, and if you could ensure that you're sending the messages to all participants as well. So if you ensure that you send to all participants and confirm that you can still hear me, and you can see the screen as well. So Elaine has responded. Thank you. Robert has responded as well. I know there aren't that many of you on the chat panel today, but it's just nice to know that you guys can hear me. Okay, so I'll crack on. We're going to start off with a bit of a recap on group cash flows. Very high-level recap, nothing in too much detail. You've obviously covered that as part of your self-study learning, but I do think before we attempt the next question, it's quite nice to just revisit some ideas about group cash flows. If you think about a group cash flow, what we're doing is producing the cash flow from a P&S's perspective together. Okay, so what we're interested in is the cash movement into and out of the P&S bubble. The thing that happens between P&S, well, we do not want to reflect the cash flow for. Okay, so if you think about what the single entity cash flow statement does, it reconciles your cash position, okay, from the start of the year to the end of the year. And what it tells the users of your accounts is where you spent that money. So if you started off with a balance of 1,000 and you ended up with 2,000, you'll tell the users in your cash flow where that £1,000 has been spent, where it's been made. Now, from a group perspective, that is in essence what you're doing, but you're thinking about P&S's cash balance together because you're treating P&S as one economic unit. So there are a couple of extra things to factor in, and 3 extra things, in fact, to factor in with regards to your groups. Okay. Firstly, you may have dividends pay the subsidiary time. Okay. Now, if the subsidiary pays the dividend to the parent, we're not going to show that in our cash flow because it's an outflow for one entity, an inflow for the other, the net impact being the nil. Okay. But if the dividend is paid by the subsidiary to the NCI, well, that is an outflow happening outside of the P&S bubble, and we therefore want to reflect that. At the time, you have dividends received. What have I done? Go back. Undo. If we think about dividends received by OCS, well, going back to our P&S bubble, if you think about A actually sits outside of the group. So if we're receiving dividends from the associate, well, that cash flow we do want to reflect in our group cash flow statement. Okay. What you may have potential additions, disposals. Now, in a question, to make things a bit more exciting, what they might just do is chuck in a subsidiary acquired or disposed of during the year. And just to put that into a bit of perspective, what I'm going to do is a little illustration just underneath. Okay, imagine you've got your brought forward numbers, you've got your carry forward. Okay, in the brought forward, you only had a parent. Yeah, you acquired a subsidiary. Carry forward numbers now include parent and the subsidiary. Okay, so let's just say add here that you acquired subsidiary. Okay, so you acquired a sub. Let's think about a very simple illustration. Let's think about PPE. Think about a brought forward number at 1,000. Okay. Let's think about the carry forward being 2,000. Okay. In a different colour, I'm just going to add on the side that subsidiary, when it was acquired, is asset of 200. Okay, so when the subsidiary was acquired, its assets were 200. Now look at these numbers in isolation, the 1,000 against the 2,000. You would think that the 1,000 additions to PPE that you made during the year. So let's imagine the absence of anything else, that £1,000, you would assume that it is the additions during the year, a cash outflow for that matter. However, it's really £1,000. Because if you look at the subsidiary, well, subsidiary, we started consolidating at our year end and we started introducing the subsidiary numbers. Did the subsidiary spend 200 during the year? Well, they just bought the asset and we're consolidating them in a group account. So really, the true movement saying part of this 2,000 includes 200 subsidiary, so the true movement is 800. Okay, that's all we're trying to factor in. That's how the examiner will test it, that they'll have these additions and disposals of subsidiaries during the year, and maybe you need to factor in, whenever you're picking out your cash flow movement, whether the true movement is, you know, the 800 or the 1,000. That's what you're trying to figure out. Okay? So, as a rule of thumb, illustrate this out using a little timeline. Okay, so if I put up a little timeline, dealing with acquisitions first. If you have an acquisition during the year, so maybe S was acquired, so end, you end up with P and S. Well, you can deal with this. Okay, you're going to have your bought and carry forward numbers to derive your cash flow. You can think about S's numbers the bought forward, or alternatively, deduct S numbers in the forward. Now, whichever method you adopt, you will get the same net answer. Okay, so if you go back to our example here, you could have thought about S's numbers, and they'll give you the relevant numbers for S at acquisition, so you'll be able to pick those out. What you could have done is added S's numbers to the 1,000 to give us the 1,200. If you compare that to the 2,000, you would have got 800. Alternatively, you can deduct S's numbers in carry forward. So if our carry forward is 2,000, you deduct 200 from that, gives you 1,800. You compare that to the 1,000 and you'll get 800. Okay, so in your exam, whichever way you played it, you're going to get the same net answer. Okay, in a similar manner, you apply that chain of thought to disposals. Okay, again, drawing out a little timeline. So at the start of the year, you had P and S, and then you say S was disposed. So at the year end, you're only left with P. Two ways you can deal with number. You either deduct S numbers forward, or you can add S's numbers carry forward. Okay, and whichever way you played it, you'll get the same net answer. So I do like to just show that example up front so you can appreciate that from a group perspective, we are trying to work out the true cash movement. And if you have acquired or disposed of a subsidiary during the year, cash movement might not just be as straightforward as comparing the bought forward and carry forward. You need to really think about, have you introduced a subsidiary in the year, or have you thought about the fact that there might have been a disposal? Okay, so we're going to put this into a bit of practice using our question question in our workbook. Okay. The next question, Chitika PLC, is actually taken from an old FA exam. So it is reflective of the sort of thing that you could potentially see even in your FR exam. And as I say, group cash flows was tested in the March exam just gone. If we look into our workbook, okay, so I'm going to bring up the workbook again. Skipper, change to, that's quite bizarre. My online version of the seems to have some foreign language at the top, but hopefully we can make that through. It seems to be only the first page. Okay, right. So what we're doing here is this question is a consolidated flow. Okay. Apologies for the rather bizarre signs and symbols at the top. That I don't know why that seems to have happened. It just it's quite a bizarre thing. Right. So what we're going to do for our cash flow question is read the core requirements. Okay. With any question we attempt, first thing we want to do is have a skip over to the core requirement. We'll then get a feel for what the examiner actually wants us to do. So what the examiner wants us to do is prepare a consolidated cash flow statement for the year ended December 2009. And they want us to do the reconciliation note. So since that is the indirect method. Okay, so at this point, having read the question, you could think about drawing out pro formas. And I do believe there is a pro forma, yes, just attached on the page. So what I'm going to do is just use that pro forma so we don't need to worry about writing it out. Well, you've drawn out your pro forma, and do realise that the pro forma that you see from a group perspective is the same as single entities. It's governed in IAS 7. Okay. Oh, asking, can we get examined on the direct method? You're not likely to see. They never really tested that from a group perspective. It will be the indirect method that you will see, Robert, okay? Certainly for your group question. Right, so if we think about the next thing that you want to be doing, you want to then have an active read of the question. Okay, I want to think about the areas of impact, and we'll try and factor in all our workings once we've read the question. So into our core question, what does that? Well, it tells us here that you've got Chitika PLC with a number of subsidiary companies which had acquired a number of years ago. Okay, tells us that on the 1st of July 2009, notice that is part year. May not be, but remember you want to keep a watchful eye on the dates. So we know that 31st of December is our year end. They have disposed of the subsidiary part year. They hold the entire 80% holding in Thiolo Limited for a cash 200,000. Okay, now 200,000, yes, that is a cash inflow for the group. However, from a consolidation perspective, we're interested in the net proceeds. Okay, so when you dispose of a subsidiary, yes, you're getting the money for disposing of your shareholding, but remember, you're no longer going to be consolidating their cash balance. Okay, so you want to think about net proceeds, which are going to be filtered through in your investing activities, and we'll deal with that when we get to it. It then gives us extracts of the group consolidated income statement for the year ended December and the SFP. So they'll always give you information in a very similar manner to what you see with your single entity cash flows, i.e. an income statement and the SFP. So here you have got the consolidated okay, and it starts off with profit from continuing operations. Okay, remember that when you do your indirect method reconciliation statement, the number you start off with is profit. Oh, that's quite bizarre. There we go. It starts off with a profit before, so definitely that number is going to be relevant. What we have is the SFP. So again, that bizarre item there, that's actually referring to the consolidated SFP, RN. Okay, and we have our non-current assets, current assets. We've got our equity and liabilities over the page. Now remember, in a cash flow question, what you're really doing is working out the movements between your respective numbers in the SFP line by line, and the question you're asking yourself is there a cash flow movement between those numbers? Okay, and the best way to deal with that is through the use of T accounts, and that's the way that you'll see the answers being presented in most instances. So over the page, that SFP continues on, and then we get on to the additional information. Let's have a read of this additional information. We pick out the relevance of it. So note 1 is telling us that on the 1st of April 2009, PLC has made a bonus issue, okay, and they utilised 50,000 of retained earnings, and the remainder funded to the premium account, okay. A cash issue was also made. Now, why is that relevant? Well, what it's telling us is that after the movement, share capital and share premium is a result of this issue. Now, a bonus issue does not give rise to a cash movement. Okay, so when we look at the comparison of the balances of share capital and share premium, we must factor in that not all of it is to do with a cash issue. Okay, we need to work that through when we do our T accounts for share capital and premium. The next note tells us that Jitterbug PLC paid an interim ordinary dividend. Okay, so it's telling us here, quite obviously, there is an outflow. Okay, and when we look at our retained earnings, we need to pick up the movement that relates to this dividend outflow. Okay. You've got 3, and 3 says an analysis of the movement of group PPE during the year has shown that assets purchased for cash totaled 360. Amazing. It already tells us the outflow as our investing activities relating to PPE. Okay, tells us there were no disposals of assets other than the disposal of our subsidiary. So brilliant. We're not going to have any proceeds on disposals of PPE. There isn't any of that to worry about in this question. They tell us there were no disposals. What then tells us quite subtly is that we could use the T account for P out the depreciation charge. Okay. Now remember that depreciation is a non-cash expense. Okay. And when we do the indirect method and the reconciliation statement under the indirect method, we're to add back that depreciation charge. Okay, so that's the relevance of note 3. We're going to use the information from note 3 to help us work out a depreciation. Okay, on the page, what we do have is some additional notes. It tells us in note 4 that there are intangible balances relating to goodwill arising on the acquisition of subsidiaries, in respect of which certain impairment losses have been written off. Okay. Now remember that impairments are cash expenditures. Okay. So because it's non-cash, we're thinking about a potential impact in our reconciliation statement. We're going to need to add back that. Okay. So the impact is on the reconciliation. And to squash my writing there, I think we've run out of space. So the reconciliation statement to add back any impairment. So we're going to work out what the impairment is and add it back. Okay. It says goodwill relating to Philo has been pre-impaired prior to the current year. Okay, so it's not to do with our subsidiary we've disposed of. It's just saying any of the movements relating to our intangibles is to do with an impairment. Okay, that doesn't relate to the subsidiary we've disposed of. 5 is relevant because it's giving us all the assets of the subsidiary we've disposed of. And what we said before we attempted this question, we should know about subsidiary disposals in the year because it's going to impact our movements, okay? So we need to think about the true movements and so going to impact the reconciliation statement. Okay. Now, the true impact as a result of the disposal of our subsidiary, we'll need to factor these in when we do our T account. Okay. What we have is the cash and cash equivalents balance of 7,900. Remember I mentioned earlier that you disposed of a subsidiary and we received money. However, we want to factor in the net cash movement, the net proceeds, because we're no longer going to be consolidating this subsidiary. So we're essentially losing out on that 7.9 that's in that subsidiary at the minute. Okay. Note 6 is giving us information about the profit or loss from our discontinued operations. It breaks down the number that they have given us in the income statement. Okay, the 360 30. Okay, so if we look back to the consolidated income statement, the breakdown of that number is profit before tax, and the loss on disposal. Now, loss on disposal isn't a cash figure, so we're not really worried about it. Okay, not a cash number. What's relevant from this is that the profit before tax number should form part of our reconciliation statement when we do the indirect method. Okay? And the reason behind this is that we are reconciling a profit number through to a cash number. For part of the year, we obviously did have this subsidiary in our accounts, okay? And we are thinking about reconciling our cash position, so we do want to include that 12,600 in our reconciliation statement. Okay, that tax number is also going to be relevant when we think about the tax movement. We'll be drawing out a T account for that. Okay, it tells us in note 7, trade the payables includes accrued interest of 5,000 and 7,000 in 2008. Okay, what we know is that in the cash flow, it is a separate disclosure. When we do our reconciliation statement, what we must do is strip the effect of that interest accrual because we deal with it separately. Okay, so now we've read the detail of the question. We'll now go in and plug in our calculations and start in that pro forma. Okay, so over the page, what you do have is the pro forma. Okay? Again, apologies for the error and errors there in my version. I don't know why that's happened. That shouldn't be the case. It really is just a title that you want to have, and that is the cash statement for year end 31st December 2009. Okay. So, numbers can you fill into this pro forma without requiring much thought? Well, firstly, and what we always encourage students to do is plug in your cash equivalents number at the start and at the end of the year. Now, if you look at the group cash flow, the group SFP, sorry, they do give us the cash and cash equivalents position, okay? So they give us the 148,500, yeah, and at the start of the year, it was the 172,500, okay? That gives you the decrease in cash and cash equivalents, okay, because it's gone down 24. Okay, you can in essence take that as just a balancing number. Okay, don't worry in your exam if your numbers don't eventually add down to that figure. It's absolutely fine if it doesn't, but churning out those easy numbers first will get you half a mark to a okay? So please make sure you deal with those first. What I'm going to do is start with my reconciliation statement, okay? I like to start my reconciliation statement first because there's often loads of marks for it. And then what we're going to do is work through the SFP line by line, asking ourselves, is there a cash flow movement in this particular item? Okay, so let's start with the reconciliation statement. Indirect method, the question specifically does ask for this. There generally tends to be 7 to 8 marks going for this calculation. Now, reconciliation statements you should be comfortable with from accounting. Okay, we always start with a profit before tax number. Make various adjustments. We make adjustments for things like the finance cost. When we do this is because finance cost is interest cost, and that is a separate disclosure in the cash flow statement. We don't want to show it as a cash generated from operations. We're going to add back the depreciation question. They also mention impairment, so we're going to jot those down as well. Okay. In addition to that, you start factoring in the movements in your working capital. And the reason you're doing this is because in the income statement, you account for things on an accruals basis, okay? But in the cash flow, we're interested in the physical cash movement. So you're trying to correct the accruals position to bring it to a cash position, okay? So all you're doing is making adjustments for things like your inventory, receivables, and your payables. Okay. Start plugging the numbers for this reconciliation. So, before tax, I'm going to take the two that they give me in the income statement. Okay. So if you put out the number in your income statement, the two that we highlighted, but at the same time, when we read the note, we had a breakdown of the profit loss on our discontinued operation, and we want to add the 12,600. Okay, relating to the subsidiary that we disposed of. Obviously, you did have this subsidiary for part of the year. You're trying to reconcile your cash position, so you technically should include the profit for that subsidiary that is mentioned in note 6. Okay, if you forgot to do that in the exam, not the end of the world, it generally only is worth half a mark or so. Okay, so start with your profit before tax, and if we total that up, 234,600 is what we get. We asked about the finance cost, and it's as simple as just adding back the 71,000 that they give us in the income statement. Okay, so we're going to add that back. Now, depreciation is a calculation. I am going to need to work that out. I'm going to refer to a working one. I'll deal with that in a moment. My impairments then, well, it does tell me in note 1 that there is there are impairments to think about. In essence, the impairment is just the movement between the intangibles number. I could really just do a bracketed working. I'll show this to you using a T account, so let's just reference that to another working. I'm going to deal with that in a minute. Inventory then, what I want to do with my inventory number is take a comparison of the carry forward and the brought forward number. If we look at the breakdown of the net assets of my subsidiary I disposed of, I do not mention inventory. Okay, so all I want to take is the carry forward number. Okay, the full one, 300. They give me that as a carry forward, the current year position, and compare that to the 393,800, the brought forward number. Okay, if I compare the two, what I notice is that inventories have increased. Now, inventories increased during the year. You can assume that maybe they've gone out and bought some inventory. So buy some inventory, that's a negative impact on cash. Okay, think of that as a reduction there. Okay, receivables, I'm going to do a similar thing. However, I notice from note 5 is that there are some receivables in the subsidiary that we disposed of. So, going back to the timeline that I drew out earlier before we did this question, if you have a subsidiary that's disposed of during the year, you think about adding the subsidiary's numbers to the carry forward or deducting it from the brought forward. I think about adding the subsidiary's number to the carry forward. Okay, so carry forward receivables from the FP 496,300. I'm going to add the subsidiary's number. Okay, so the subsidiary that's been disposed of, and I'm going to compare that to the forward number. Okay, that through my calculator, what I notice is that receivables has increased. Okay, if the receivables have increased, I can take the assumption that these customers that I'm dealing with on this time, they aren't paying me on time. So you can think of that as a negative impact on your cash flow and a reduction there. Okay. Payables then slightly involve the payables because yes, you've got the subsidiary disposed of, but then in note 7, they also mention that interest accrual that we need to strip out from the payables number. So I'm going to start off with my carry forward and on the subsidiary's number, and then I'm going to remember to bring my interest accrual. I'm going to add that back. I want to deal with my interest accrual separately. Okay. I want to compare that to the 11,700, the brought forward number, and I'm running out of space there. So I'm going to deduct. Oh, I just realised I've made a bit of a typo there. So I want to strip out the effect of the interest accrual. Apologies there. I want to strip out the effect of the interest accrual. Okay, the 5,700. So I'm taking that 5,000 out. That's interest accrual. Stripped out from the forward number as well. And that to me in note 7. Okay. Now to plug those numbers in my calculator, what I realise is that have also increased. Okay. The increase in my payables, I can assume that I'm taking longer to pay my suppliers. So that's a positive impact on my cash flow. Okay, so that will be the 48,100. Okay, I don't have a few numbers to work out there, so I can't total things up yet. What I am going to do is move on to a working one for my PPE. I'm starting off with the first line item in my SFP. Okay, so if I draw out my T account for my PPE, I will plug in my brought forward number, the 695. I will plug in my carry forward number, the 723. And what they told me is 3 additions. They told me that during the year they had acquired some assets at a cash price of 360. Now really, if I wanted to, I could slot that number straight away into my cash flow pro forma. Okay, I would filter in everything at the end, but you could have done that because that's an easy mark. Okay, we didn't need to calculate that, that was given. We also get told is that there are disposals. There's disposals of a subsidiary, but not disposals of a non-current asset. They tell us there aren't any disposals of individual assets, but we do dispose of a subsidiary. So what I'm saying is that part of that brought forward number would have included some of the assets of the subsidiary, which in the carry forward number we're no longer including. Okay, so we need to factor in that disposal, the rate 900 mentioned to us in a separate note. And if we try to balance out this ledger now, what we'll realise is a difference to our depreciation charge. Okay, so balancing number there is to be the depreciation. Okay, and that is the 22,700. Okay, so what we'll do at this point is tick off my PPE number. Okay, I want to go along and tick off every single line item I've dealt with it. Okay, so 22,700, I can plug in that number and on to the second line item in my SFP. Okay, and the second line item in my SFP is my intangibles. So let's think about a T account for my intangibles. Okay, so let's draw out the T account here. To my intangibles. You start off with your brought forward number, the 3,73700. Okay, and have your carry forward number, the 364,200. Now they don't mention anything else about intangibles. Really, we have is the movement that's going to equate charge. Okay, they do tell us in a note that the difference between the intangibles is the impairment charge. Impairment is a non-cash expense. The balancing number there, the 9,500. At this point, I can go and plug that number in to my reconciliation statement. So I'm going to scrap 900, my impairment. So at this point, what I've done is completed my reconciliation statement, and I add all the numbers, the 331,900. Okay. I'm going to move on with my SFP. I look at current assets, and I have ticked off the inventories line. Okay, so if I just bring up question again. What we're doing in essence is working our way through every line item. Okay, so we ticked off PP, we've ticked off intangibles, we thought about inventory movement already in our reconciliation statement. Okay, what we have is trade and other receivables. We've dealt with that in our reconciliation statement. Cash and cash equivalents, we've already populated those numbers on our core pro forma. So where does that bring me? It brings me to equity and liabilities. I think about the movement in my share capital and premium, remembering that there was a bonus issue. Okay, so go back to my working. I produce a working 3 for my share capital. Okay, and so I'm going to plug in a account premium. Okay, so I have my brought forward, the 400, so the carry forward, the 50. Okay, and with my premium, I've got the brought forward, carry forward, all of these numbers directly taken from the SFP. Now, what tell me in note 1 is that a 1 for 4 bonus issue was made. Okay, so ordinary share capital was 40,000, and 1 for 4 bonus issue was made. What would mean that 100,000 shares are issued. Okay, so the issue would mean an extra 1,000 shares are issued. Now, what tells me in note 1 that this was funded 50,000 out of retained earnings, or the rest of it from share premium. Okay, so yes, we're crediting the share capital, but we want to debit the share premium for this issue. This wasn't taken to the retained earnings, therefore 50,000 to the share premium. Okay, and just for reference, mentioning that it's coming from the information in note 1. Okay, what we'll now do is try and bounce off our account. You will find is that there is an imbalance of 50,000. Okay, assume that is the issue that made during the year and the cash proceeds we've received on it. Okay, 50,000. Okay. And if we total up our share premium, the 265, balancing entry, each entry there, the proceeds and the issue, the 125. Remember from accounting that when you make a share issue, you take part of the number, the nominal value, to share capital, the excess is the premium. It is the summation of the two which gives you your cash entry. So if we do say the two together, well, quite drawn a nice little arrow for us. We have total cash movement 175. Okay, 175,000 there, I'm abbreviating the K there. And now tick off share capital, share premium. Move on to the next line. The next line in our SFP is retained earnings. Okay, so we're going to deal with working for, and we'll call that. Ooh, what's happened there? There we go. Let's just play. Go to my retained earnings. So let's write my pen. Retained earnings. Remembering to factor in that bonus issue adjustment as well. Okay. So you do have a brought forward of 295,100. You have your carry forward of 303,140. Remember the bonus issue, as told us in note 1, part funded by the retained earnings. In addition to that, during the year, they've made profit. And this is a group SFP group cash flow question. So what you must take is the profit attributable to the parent in the retained earnings. And there is a difference. The difference is because a dividend has been paid. And it does actually tell us in a note that a dividend was paid, so we do need to work that out. So we have a total 640, and the balancing entry would be the dividends paid. Okay, and that is the 27,500. So just like you normally treat your retained earnings account, when you think about single entities, you draw out this T account, you plug in the numbers for the income statement profit generated, the balancing entry is the dividends paid. And you're applying that logic with your group cash flow as well. Okay, we take off the retained earnings to now bring us to working for the NCI. Now remember what we said when we did our brief cap on group cash flows. One of the extra cash flows from a group perspective that you may be interested in is dividends paid to NCI. Okay, so I'm just going to draw my T account for my NCI. I've got forward 498,800. I've got carry forward the 48,260. I've got profit attributed to the NCI from my income statement, AO 530. But then what I have is a disposal of a subsidiary during the year. So what I want to show the users of my accounts is that really part of the reason that that number has changed is because of a disposal of a subsidiary. I'm going to put that in a different colour just to highlight to you where it goes. Okay. So it's the elimination of the NCI on that disposal. And the way you would calculate that, here it's share of the net assets method that we're assuming. So we're taking the NCI percentage. In this example is 20%. balancing and so was 80%. And multiply that by the net assets at the disposal date. Okay, the net assets at disposal date given note 5 is 306,100. Okay, so this is given in note 5. It is subsidiaries net assets at disposal. Now apply that through, you have 61220. That's a bit of extra for you to think about. Remember that if you have a subsidiary disposed of during the year, you're saying that part of the reason your NCI balance has changed is because you've got rid of the NCI to relate to the subsidiary you've disposed of. Okay, so that's essentially that entry there. What you will find is a balancing entry for your dividends. So if I total up, 1330. Balancing number that is going to be my dividends. And that means the 11,850. Okay. I can now move on to the equity section to think about liabilities. And if I go back into my SFP pro forma, let's kick off share capital. We've dealt with share premium. We've dealt with retained earnings. We have dealt with NCI. We now move on to liabilities. Now, I think the movement with your liabilities there is straightforward as just taking the difference between the two, so I'm not going to bother drawing out a T account. Okay? We dealt with trade payables already, so that leaves us with the tax payable to account for and also the interest accrual. Okay? So I'm going to go back into my working. Working 6 to do my tax. Now I have a brought forward number of 36300 and I have a carry forward number of 33900. Okay. Now in the income statement, okay, you got tax split up as 69900, but then you had separate tax to pay with regards to your discontinued operations. So you do need to factor that in. Okay, quite bizarrely here they split out the tax on their discontinued operations, so you need to factor in a note that they give us about the subsidiary we've disposed of, the 3750. Okay, so if I can reference back the note that it mentioned the 3750, well, that's note 6. Okay. Our T account. What you end up with is a balancing entry, which is your cash payment. So during the year, we ended up paying out 76050. Okay. That tax entry, and we have one final T account to deal with. I've run out of space in this page, so I am just going to take another page to work through our final. Oh, that's rather fine. Well, let's try and do that again. So, a T there for the interest accrual. Okay. Now, interest accrual, they told us in the last note the brought forward position was 7,000, carry forward was 5,000. In the income statement, we reflected 1,000. Okay, so ultimately, the cash payment that we've made is balancing entry of 73,000. Notice is that with each working, all we've done is to recreate the T account based on the information they've given us, and we asked ourselves, is the cash movement? And the balancing entry we've always assumed in the absence of anything is a cash movement. Having done all the T accounts, we're at a position to just plug in our numbers into our pro forma. Okay, I'm going to do precisely that. We'll go back workbook, and let's just plug in our numbers. Okay. Oh, I've gone back far, haven't I? There we go. A bit further down. So, start off with operating activities. I worked out my cash generated from operations at, let's write in black, and so 331,900. Okay, I can reference that back to my reconciliation statement. The paid, well, we've just worked it out. 73,000. Okay. The tax paid worked out as 76050. Okay. And it's an outflow, hence the negative there. The total cash flow for operating activities is the 182,850. Okay. The PPE, what they told us in note, the 360. You could have potentially plugged that number in straight away. Now, with regard to the disposal of Thylo, well, all you're doing is taking the net proceeds here. Okay, so what they do tell us in the question is that they had received, if I can just find the note again, that they had disposed of a subsidiary receiving 200,000. Okay, and the cash balance in subsidiary at the disposal date was 7,900. So if we think about taking the net, that is the 192,100. Okay, that gives us a total cash flow from investing activities a negative 167,900. Okay. What we have is the financing activity. Those repayments, well, that's just the difference between liability numbers. So if we plug our liability numbers, that's just the difference between the 736, 300 and 561, 700. Okay. That's going to give us 474,100. Okay. The proceeds from the share issue, we worked that out. And let's put a negative. It is an outflow. Okay. The proceeds from the share issue was the 175. Okay. It was the summation of the difference in the capital and the premium. Dividends paid by the parent, 500. And to the non-controlling interest, 11,850. So now, if you total all of that up, financing activities, it's a 38,950 as a negative outflow. Okay. If you total up, then the respective cash flows for your operating, investing, and financing activities, you end up with the decrease in the cash and cash equivalents. Okay. I think that's us having answered the question on our group cash flows. And you have been on the chat panel, so I'm hoping you're understanding this, and I'm hoping you found this useful and beneficial for your revision. So certainly you could see something of this nature in your exam. At revision, you will definitely be practicing some more questions like this from a group perspective, also for your single entities as well, so you can really get prepped up before the exam. Okay, so I'll call it a day then. Unless there are any questions or issues, I'm going to stick around. Okay, I will stick around for a little while. But it'll be this is recorded, so obviously if you want to listen back to some of the stuff that we've covered with group cash flows, I know I've gone through that. So to add a bit of a speed, given the time constraint that I have for the tutorial today, but certainly you can hear it played back, and we'll upload that on the communities. All right. So lovely evening and good night from me. I'll stick around if you've got any issues or concerns. If not, I'm sure I'm going to be seeing some of you at the S's and revision. Oh, brilliant, Robert, as your brain stopped working. I don't blame you, to be honest. It's pretty late in the day, and I sympathise with that. I've been a teacher as well, and I'm feeling, woo, well, that's a lot of information. And, well, you're welcome. I found that useful.